Welcome back. President Trump taking aim at Goldman Sachs economists and CEO David Solomon in a Truth Social post yesterday, writing, quote, David Solomon and Goldman Sachs refuse to give credit where credit is due. They made a bad prediction a long time ago on both the market repercussion and the tariffs themselves, and they were wrong, just like they are wrong about so much else. I think that David should go out and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution. This in reaction, of course, to a note on tariffs from Goldman Sachs, the economics team led by Jan Hatzius, citing that U.S. consumers have absorbed 22% of tariff costs through June, but that their share will rise to 67% if the recent tariffs follow the same pattern as the earliest ones. Joining us here at Post 9 is David Mericle, Goldman Sachs chief U.S. economist. What was the reaction on the economics team yesterday to this post?
Yeah. Well, look, we stand by the results of the study. I think it's very early to be drawing definitive conclusions about how tariff costs will be shared. But in principle, tariff costs can be borne by foreign exporters, by U.S. businesses, or by U.S. consumers. Now, we've had tariffs in place on that very first round from China for about 5-6 months, so I think we have learned a little something. Our conclusion is that U.S. businesses have borne most of the tariff costs so far because it takes time to negotiate lower import prices or to pass price increases along to consumers. But if the most recent tariffs, like the April tariff, follow the same pattern that we've seen with those earliest February tariffs, then eventually, by the fall, we estimate that consumers would bear about 2/3 of the cost, foreign exporters would bear about 1/4 of the cost, and U.S. businesses would absorb less than 10%. That probably sounds small, less than 10%, but bear in mind that is a net number. If you are a company importing or using goods to sell in the U.S., you're going to get hit harder. If you are a company producing in the U.S. who is now protected from foreign competition, you can raise your prices and benefit. So those are our estimates, and I think actually they're quite consistent with what many other economists have found.
So our debate has been about whether or not the consumer at this point is so fragile that they won't absorb those price increases, and it'll fall on the company once again. The U.S. importer. Why wouldn't that happen?
Yeah, I think there will be some split. What we generally saw in 2019 was that a surprising amount fell on consumers, in part because companies did pass along much of the cost, but also in part because there were additional spillover effects, where, again, if you're protected from foreign competition, you take the opportunity to raise your own prices. I agree with you that the consumer looked fairly fragile in the first half of the year. Consumer spending growth decelerated a lot, despite the fact that real income growth still probably quite a bit sturdier in the first half than it's going to be in the second half. Job growth is slowing, so labor income growth will slow. We got some one-off Social Security back payments that we're not going to get again. And as tariff effects on prices continue to accumulate, that will further erode real or inflation-adjusted income.
I guess the problem the president had with the research is that everybody expected this all to be very inflationary when he announced tariffs. And so far, we've had inflation report after inflation report that has not shown it feeding into the overall headline rate. I mean, a little bit of tick up here and there, but it's not. I mean, you have to be surprised that we haven't seen it in a bigger way. That's why the market is rallying now on the idea of a cut.
So one thing that I think we've learned that maybe I didn't fully appreciate is just that for very mundane reasons, there are implementation lags that delay these effects. Anything that was on the boat is exempt. That gets you from that big April 9th reciprocal tariff about a month into May. And then Customs doesn't charge people every day. Sometimes those payment lags can be another month. So to expect to have seen all of this by June and July is just a little premature. We think so far the effects, I agree, have not been huge, but are worth about 0.3% on core consumer prices. That is a little bit smaller, actually, than the Fed's estimate. Their estimates have been a bit larger than ours. But I do think most of the impact is still ahead of us. I'm not worried about it. I think, like the White House, like Fed officials, we would see this as a one-time price level effect. I see the inflation picture as a two-part story. You have a falling underlying trend, leaving tariffs aside, that is moving back to 2% for the same reasons it has been for the last 3 years. But I also think that these tariff effects will push in the other direction, probably push inflation above 3%. I don't think this will matter a whole lot to the Fed because now they have a labor market to worry about. Yeah. And I think that's going to be the dominant concern.
Core CPI, 3-month annualized. Has it not gone from 1.7 to 2.4 to 2.8 in 3 months?
There's a lot of volatility in these numbers. That's right. I think a very simple way of looking at this, I mean, we and the Fed, of course, have complicated econometric models where we try to trace out the impact of tariff increases at the very granular category level, controlling for other factors. But a really simple thing that you can do at home is just look at how core goods, which are affected by tariffs, have deviated from their pre-tariff trend versus how core services, which are barely affected, have continued to decelerate, as they have again for the last couple of years. That gives you at least a very rough...
Core services were the reason that the core moved up yesterday in the report. It wasn't as much as goods.
That's right. So services were a little bit firmer. And I think, it's a good illustration of the volatility we deal with every month that doesn't really fit any broader narrative. We have volatility in airfares. We had a jump in dental services. Kind of a strange thing, but that sort of thing happens.
David, most people come to work every day in this country without the expectation that the president is going to publicly post that they should be fired. I'm just curious. Did it send a chill at all through the team yesterday and your economics team? Does it change the way you do anything or look at anything or interpret the data?
We're just trying to do the best economic forecast that we can for our clients, and we publish research reports like the one that we published over the weekend to inform those views, and we'll keep doing that.
All right. Thank you for joining us and for commenting on it. We appreciate it. David Mericle, the chief U.S. economist of Goldman Sachs.